Good morning, good afternoon, and good evening, and welcome to the Nest on Clubhouse. My name is Jim Chu in San Francisco, and I'm the CEO of Untapped Global. Our job is to connect international investors with entrepreneurs in frontier markets, including those in Africa and Asia. We host weekly discussions about entrepreneurship and investing, like today's on Clubhouse. And once a month, we host a pitch session with startups and investors from around the world. You can find out more about Untapped and the Nest and follow us at Untapped Global on Twitter and LinkedIn. And you can join our WhatsApp community by going to untapped-global.com and clicking on Engage. Today's topic is venture debt in Africa. We've had previous sessions about venture capital and alternatives of venture capital. And what many have pointed out is that there's a big gap in venture debt, meaning debt instruments or non-equity investing that allows earlier stage companies to scale up and move to later stage / more established companies that can get conventional debt. And so today we have a number of very interesting panelists who in various ways have addressed this issue with their funds and would love to hear from them. So without further ado, I'd like to introduce some of the panelists today. We first have Camilla Nestor, who is the CEO of MCE Social Capital. Camilla, would you like to introduce yourself a bit and tell us a little bit about MCE?
Great, thanks, Jim. Thanks for pulling this together. So I am Camilla Nestor. I am the CEO of MCE Social Capital. We're a nonprofit impact investing firm looking to create economic opportunities for people in the developing world. And we do this by investing debt capital in small and growing businesses and financial services providers. We source our capital through a pretty innovative, unique model. We raise guarantees from family offices and individuals, essentially leveraging their balance sheets. And those guarantees then back our borrowings from commercial banks and development finance institutions. And we also raise capital through a private notes program for accredited investors. We then deploy that capital into companies in the developing world who meet our underwriting criteria. And one, I think, really great advantage of this guarantee model is it allows us to dial up the impact. And one example of this is at the start of COVID, when many investors, even impact investors, were kind of spooked and pausing on their investments. MCE continued to put capital out the door, especially in essential sectors in Africa, like agriculture, giving these companies really critical liquidity. Just quickly about me, I'm relatively new to MCE. I joined about 4 months ago, and over my career, I've spent time both as an investor and also as an entrepreneur. So I like to think I understand both sides of the table, but definitely have spent more time in investors' shoes. And I think back over to you, Jim.
Great, and for full disclosure, I'm a guarantor, so I've definitely gulped the Kool-Aid, but I just have to say that MCE is a fantastic organization, and their model for both raising money and deploying money is fabulous. You know, they've really understood what both investors as well as entrepreneurs need, and have put together a legal structure that really optimizes from a tax perspective for investors, but also are really helping entrepreneurs that wouldn't otherwise be able to access capital. So big fan. If you guys aren't familiar with MCE Social Capital, please connect with Camilla, and I'm sure she can tell you more about it. Thanks for joining us today, Camilla. And over to Kwame. Welcome, Kwame.
Thanks, Jim. Hey, everyone. My name is Kwame Williams, and I am calling you from Accra, Ghana. Apologies if the internet cuts out or you hear a plane fly overhead. I am a recovering aerospace engineer who has transitioned from being a rocket scientist ultimately to co-founding and leading Moringa Connect and our flagship brand, True Moringa. At True Moringa, we make skincare and wellness products using superfood ingredients grown by small farming families in Ghana. We built, in essence, a vertically integrated supply chain connecting farmers from the soils of Ghana to the shelves of Whole Foods. And I'm excited to share a little bit about how we've leveraged debt financing throughout our growth and how we've as well worked specifically with MCE in that journey, and as well share about some of the gaps that we see to help more African entrepreneurs and businesses access the capital that they need to grow. And just a quick sort of synopsis of my story. I loved aviation as a kid, broke everyone's toys trying to figure out how it worked, and was fortunate enough to immigrate to the US, where I studied aerospace engineering at MIT, interned at NASA thinking that was going to be my future. And once I learned about the moringa tree, everything changed for me. I realized that the leaves of the tree contain more iron than spinach, calcium than milk, protein than yogurt, and the seeds contain a deeply moisturizing oil that outperformed argan, coconut, and shea. And my co-founder and I realized that we needed to connect the dots for the opportunity that moringa presents rural farming families. And today we're really proud and excited to share that we've served 5,000 farmers here in Ghana, have planted 2 million trees across the country. We're growing triple digits back-to-back years in spite of COVID. And we're currently positioning around a blended financing round of $2 million in equity, as well as 1.5 in debt. And so excited to share more about that journey with all of you. Thank you.
So I have a very important question. So which is harder, designing rockets or raising capital for a social enterprise in Africa?
Jim, this is the $1 million question. At this point right now, it feels like raising capital as an underrepresented founder is a lot harder than my aerospace engineering problem sets and work I did at NASA. So yeah, I would say that's harder for me right now.
Good. Well, welcome. Thanks for joining us. And then over to Rob Eloff from Lateral Capital.
Thanks, Jim, and great that everyone's joined us today. Quick intro on my side. I'm a South African that spent most of my career investing in emerging Africa, Latin America, and Eastern Europe. And today we look at sort of the hype and excitement from traditional venture capital centers looking at at Africa. That wasn't the case 5-6 years ago when we got started with Lateral Capital. We are a life cycle VC fund, meaning that we look to be able to back and support founders from pre-seed through beyond Series A. And I'm really glad, Jim, that you defined venture debt quite broadly today, and with your permission, we can cast the net quite wide to perhaps include all non-equity financing. With Lateral, so far we've backed 17 companies, all with the common denominator of delivering foundational technology across sub-Saharan Africa, and our team is spread out between Lagos, Nairobi, Tunis, and South Africa. And I think by way of context as well, when we got started 5 years ago, initially as angels, we saw this massive problem of founders in sub-Saharan Africa being held to sort of revenue multiples and metrics that were more common in Silicon Valley, without acknowledging that in many ways in Africa, entrepreneurship is a necessity. And it's only recently in the US that people have rediscovered the second KPI called profitability that turns out to be pretty important too. But founders in our markets have prioritized both growth and profitability from very early stages, and so it was an interesting problem for us to think about potential augmented or alternative models to traditional VC, places like Silicon Valley and other centers of venture. And so a number of our portfolio companies we've worked with the founders to be creative around having financing models that relate to delivering on growth and profitability. And I think, as you rightly point out, there's a lot of sort of VC capital that we call Afri-curious, but not so much yet in sort of alternatives to just sort of traditional round by round venture rocket fuel. And so for us, it's been a really fascinating and rewarding journey to sort of try and assess the needs of founders bottom up rather than top down.
Wow, great. So I think that it's a really good segue to really the opening question here, which is, first of all, let's define it. What is venture debt? But before you guys answer that question, I want to remind everybody that this session is being live streamed and recorded. And so I want to make sure everyone knows that. And also, if you have friends and associates, colleagues who want to listen in on this conversation and even participate, but aren't on Clubhouse, please feel free to send them to Untapped Global on LinkedIn. And you'll find the event on LinkedIn and the links to the live streaming so they can listen in and comment on this conversation. So with that, turning over to the panelists on the question, what is venture debt? Anybody?
Jim, I think, what we realize is that venture debt on the West Coast of the US traditionally for a lot of people meant warrants and having, sort of deploying debt with some kind of upside kickers. And typically the kind of risk I think that was being taken there was financing risk, on the next round of financing. So often between rounds, we've sort of chosen to include in that definition and look to deploy everything from revenue-based financing, term loans, revolving credit facilities, really anything that is not traditional equity via safe notes. We even think of convertible debt really as equity. So everything but that, I think, in sub-Saharan Africa is relevant as venture debt.
So what I hear really is that we need to adapt the concepts. I mean, so if I were to define venture debt in Silicon Valley, at least, it's really that bridge round, if you will, or not necessarily bridge, but rather a accelerant so that an earlier stage company that was built on equity investments can reach a later stage at a higher valuation so that they don't have to sell as much equity to get there. And so I see it as part of that capital to scale. And as you said, it's done in very specific ways in the Valley, but in Africa, it needs to be done in a different way to accommodate the differences in exit markets and also the capital needs and also the types of companies that need that debt.
Yeah.
I think Camilla, go ahead.
Yeah, I was just going to jump in there. So very much agree with Rob. We're looking at this as broadly as possible at MCE. And so maybe kind of flipping venture debt instead of going with the traditional definition here in the US, looking at it as essentially debt for early stage companies with a few similar characteristics to the traditional venture debt definition. So number one, non-dilutive to founders, and number two, less expensive than equity financing. But what's different is number one, still fundamentally a debt structure. So not looking to veer into the equity side of the balance sheet with warrants. And then looking at a really kind of broad range of structures that fit into the middle of the capital stack or that mezzanine territory. And similar to Rob, revenue-based financing. We're working on our first structure right now with a company in Africa on a revenue-based deal.
Very happy to hear that.
Yeah, it's really, we're excited about it. And it's something we want to do more of because we do see a really significant demand for these types of flexible structures from the entrepreneurs in our pipeline.
Gotcha. No, great. And so is that, I guess one of the questions is, some of the reasons that it's difficult for financing institutions to offer this type of alternative debts is they're very much restricted in terms of what they can do, what type of instruments, how much risk they can take, what kind of companies they can finance, etc. To what extent do you see limitations of LP expectations, investor expectations being a barrier to that, or even LP understanding of these alternative assets?
Maybe I'll just jump in here quickly and then see what Rob or Kwame have to say. But so I think that's one of the things, Jim, you mentioned about MCE that really I find unique about our model is our ability to take a little bit more risk and be flexible in terms of what we can offer given that guarantor structure. But I do have to say, as we start exploring other types of structures to raise additional capital where we're sort of matching risk return appetite among impact investors, we do see a little bit more reluctance to explore the mezzanine space, which surprises me because there's tremendous demand and need there. And there's also an economic reason to do it as well. I don't think, So that is something that I'd love to see some of the more mainstream investors in the impact investing space start to be a little bit more curious about.
Well, good to hear. Rob, thoughts on that? On because you have DFIs in as LPs in your fund as well. Do they ever say no, you guys can't do that?
Yeah, Jim, we've got everything from DFIs to family offices to to actual founders in Africa. I think that the most helpful way to frame a good outcome here is to just be very explicit about the problem for founders and the problem for capital providers. And this is a big oversimplification, but I like to think of this as a dilution problem for founders. They are looking to finance growth, and potentially the milestones that a priced equity round would reward haven't fully been delivered, but there's traction and the direction of travel is good. The problem for capital providers is a data problem, right? Because the way that they assess, risk and reward is on delivered traction, or let's be honest, more often kind of the endorsement of other capital providers. And so if you think of this as sort of solving dilution and solving for data provision for those two participants in this ecosystem, some interesting things can happen. I'm glad Camilla mentioned revenue-based lending. I think what's really exciting now is the ability to solve the data problem by using, sort of the massive adoption of APIs in our markets to sit side by side with a founder and have much better visibility on sort of, in between round traction and reward that, on a micro basis. So especially on the revenue-based lending side, I think the challenge and why we haven't seen more of this is, in an old economy sense, needing to go and find cash flow data and get, monthly or quarterly reporting, whether that's in sort of a Google Sheet or a PDF or anything else. There's still a lot of search costs and friction with that. The ability to sort of really, in some cases, deploy APIs to have real-time cash flow monitoring for a business makes it so much easier to deploy capital, in between rounds. So I think that's one way that we should think about trying to drive, more attention and capital towards this alternative, is how you bring transparency and offer data as a solution. And then, on the dilution side, just for founders, I think we've had a really good experience on setting very clear milestones for equity financing rounds and helping micro deliver those along the way. A good result for us is where either our non-equity financing is replaced by cheaper capital, or our non-equity financing really is our due diligence in writing a much bigger equity check down the line.
Right, I think you bring up a really interesting point, or important point, about technology and how technology, when I say technology, I mean mobile technology, digital payments in particular, how that is changing how we even look at risk. And obviously risk and cost of capital are very closely related. And so if we're able to really use and leverage technology to reduce the risk and also reduce the administrative cost of lending to fast-growing businesses, that changes quite a bit. That really changes the equation on how we do things. So I'm plugging a little bit on what we do at Untap, but we're big on the technology-driven approach. We have an asset class that we call smart asset financing. And we basically take digital payments as the form of, if you will, the invoice factoring even, to provide financing to fast-growing businesses. So we think more and more data-driven, technology-backed financing is an unexplored area that has a lot of potential for growth. Kwame, you're about to say something. Go ahead.
Absolutely. If I could just add to Rob's thoughts, I think that the problem is absolutely a dilution problem and a data problem. But I also think that there's just like a fundamental access issue on the entrepreneur side, and then on the LP side, a reality check about equity on the continent. I think that, a lot of us have drunk the equity Kool-Aid to say that, equity is a way to invest in companies and grow them. But I still think that is a working hypothesis, especially when you leave the tech bubble, right? And you start looking at other industries on the African continent and trying to think through what is the best financing instrument to give investors an attractive IRR, and also give founders the capital they need to scale. And I think just the honest truth is that we haven't seen as many exits in equity as possible, as sort of the marketing likes to make us believe, whether that's on the PE side, whether that's management buyouts, whether that's strategic acquirers. And so I think more LPs need to say, hey, how about we start thinking about self-liquidating instruments as part of the mix of instruments that we deploy, rather than all chase this, $100 million business is going to be valued, $100 million turnover business that's going to be valued for $1 billion and make us all happy. And so I think, to me, as a founder that's experienced a lot of blended financing, debt, different forms of debt, and is raising an equity round right now, has raised quasi equity in the form of convertible debt. I just think it would be to the advantage of investors to consider a bigger mix of instruments. And then for entrepreneurs, as a Black founder, right? If the stats are something like less than 2% of venture goes to Black founders. And then on the continent, the 90% of VC and investments that are being made are going to expats, not to Ghanaians, indigenous founders. And so when you think about the access issue, you also see that venture has a bias right now that still has to be addressed. And so I see venture debt as a interesting opportunity to start fixing some of these unjust frameworks and biases, and giving founders more access to capital. And just to share a little bit on Jim, your point just now around technology is changing things. Right now, True Moringa and Moringa Connect, our company name, we just closed a really large purchase order. So this purchase order alone is more revenue than we earned all of last year, and it was amazing to go to, because we have a U.S. entity, to be able to reach out to non-bank lenders and have them say, hey, I'm just going to integrate with Plaid into your bank account, your Shopify, your Facebook, and metrics, and based on that, I can make a decision about whether or not to finance you. And I believe that that's absolutely the future that we have an opportunity to leapfrog towards here in Africa.
Indeed. For
funds to say, let's build the integrations, just like you're doing, Jim, at Untapped, and let's leverage technology to give us those insights with the local bank here. And maybe it's a bit high touch. You have to hire a fresh out of college intern that serves as the sort of accounting rep to serve a certain number of companies. But it's absolutely possible to fix the data problem, to fix the transparency problem, if funds and LPs as a whole are actually interested in pursuing this.
Which they should be, which they absolutely should be. And, just as a quick comment on some of the things you said about access and fixing, I see it as one of the biggest blind spots out there, right? There's so much talk about venture capital. There are multiple reports every year about venture capital going into Africa, and I think all that is great. But I think there's a major blind spot that folks such as Robin and Camilla at MSCE are trying to address, which is, hey, there's this huge need and untapped market of smaller, or I should say smaller necessarily, but SMEs who may not be VC applicable, and they don't have the kind of businesses that are right for venture investing, but are absolutely great businesses and absolutely are great to back and can be backed profitably. And it's a massive market to tap into that one's really addressing. So I think that's the holy grail here. If we're able to crack that nut and channel more financing to SMEs that don't fit the venture model, I think it can drive economic development for the entirety of Africa in a way that venture can never do.
Yeah, Jim, I think it's maybe a great place to sort of talk about what kind of businesses this works well for, and sort of some of the things maybe that investors look for in considering alternatives to traditional equity, if we can go that direction.
Please, please.
Yeah, I mean, just a couple of top of mind factors that we've had success sort of screening for. I think the most obvious ones are businesses that have fairly decent, steady recurring revenue. That's challenging. The notion of SaaS in our markets looks a little different, and enterprise customers in Africa, software as a service doesn't really always fit their budgets.
Right.
But that's changing. That's definitely changing. I think definitely we believe that African founders build businesses that tend to have the potential to have great margins from a pretty early stage, and so we really try and prioritize that. And then the third piece is businesses that actually have downside protection, that have assets, which Kwame could definitely speak to. We see it a lot as well, where we're investing in either hardware or some sort of asset-backed business that can scale using technology. That tends to be fertile hunting ground for us. I believe Chris Hale from Carnival was in the audience and might still be, and he can certainly sort of speak more to that maybe later on in the chat.
I'm not sure if Jim's on mute, but maybe just.
Oh, I'm sorry. Yes, I was indeed on mute.
All right, I'll let you finish.
Rookie mistake. Go ahead, Camilla, please. Please go ahead.
I was just going to react to something Kwame said and throw a question back to him. So, really glad you raised the kind of the gap, particularly for local founders. And I think we also see similar statistics for female founders. One question for you: are you also seeing a gap from country to country in Africa? So, for example, countries that are less on the VC map, where there's less clarity around the capital continuum, like who's going to come in for the Series A or the Series B. Are you also seeing fewer investors there? And it's something we're thinking about at MCE, because we do try to go into what we think of as like more frontier markets that have less in the way of investment capital going in, but there is that question.
Camilla, I think you're absolutely right that there is a gap country to country. I've actually spent a couple hours the past 2 days with a great friend of mine who's building a really exciting agriculture business in Cameroon. And she's frustrated because she grew revenue 2x 2019 to 2020, and yet is having a challenge accessing all the instruments, the debt, equity, convertible, and the reality is she's building from a francophone country, and so she is sort of kept out in a sense of the larger, more US-based Anglophone preference in investing excitement, and so I absolutely think that there are gaps country by country. So there are gaps in both sectors. A lot of financing is going into, for example, Nigeria and Kenya for tech. Right, it's been amazing watching what's happening, especially in fintech. Over the past few years, and as well even the exit that Paystack achieved. But the reality is outside of that sector, there isn't as much action. and you're not seeing the capital flow to founders that are investable, that can build attractive returns for the investors.
Yeah, I mean, I've heard so often as an investor, a venture fund or a fund coming saying, so what's your investment thesis? I would ask, and they come back, well, yeah, it's venture asset light, hot. Hold on, how many businesses are in Africa that are generating revenue now are really asset light businesses? That's very much a cut and paste from Silicon Valley model, and I think one of the biggest opportunities that are really untapped for financing are asset-heavy businesses that really just need the CapEx financing or the working capital to grow their businesses. And they're businesses that are already generating revenue, to your point, Kwame, and to something Rob said earlier, and already have very good cash flow to cover it based on their existing business model. So maybe that business won't grow 100x, or it won't be able to exit for 100x because it's a proven business model that's just been around, but it's a great business to support and grow because not only can it have great returns, but it also has tremendous economic impact on the ground.
Jim, I'm happy to challenge the 100x with asset-backed businesses. And I think one thing that's really interesting about sub-Saharan African technology ecosystems is, whether you're building software or hardware, oftentimes you're building infrastructure. And I definitely see asset-backed venture with the potential to return very attractive multiples. Happy to decide on a wager to look for us to settle on bringing you a 100x business that does have hardware or real assets. And I think it's also a tremendous moat, whether you're looking at last mile fulfillment for e-commerce, clean energy, or even trade financing and trade tech, such as what the folks at Carnival are building. That is a tremendous moat when you're up against eventually well-funded, US and European technology companies coming into Africa, because sometimes asset ownership is a great moat.
Yeah, no, indeed. Well, we do have a lot of folks in the audience who raised their hands and have now joined us on stage. Love to hear your comments and your questions for the panel if you have any. And but before you jump in, please introduce yourself briefly so we know some of the context, and love to hear your comment or question. Should we start with Dan, who's been waiting? Dan?
Thanks, Jim. Real quick background. My name's Dan Kleinbaum. Started a company called Bionic in Uganda in 2013. Exited to MFS Africa last year. I think I've been consulting and kind of working in the fintech space for the last couple of years. Think a lot about the access issue, but I'm kind of more interested in the debt side of things. I'm curious to know what either blended finance mechanisms or, regulatory, innovations or things that can open up access to debt. And I guess I'm in this context, I'm working with some folks that are really looking at how to put more, particularly that, $5 to $25 million sort of debt vehicles into the ecosystem. And so, seeing things like, like the mortgage backstop sort of mechanisms in the US, like could you do something for cross-border debts or some ways that, you have access to payment streams or, assets or cash flows in a different country than you're operating in. I'm curious to know what you all are seeing that's kind of opening up this type of venture debt.
Well, I think a couple of folks on the panel can address that from a couple of different angles. In fact, I think Camilla, would you be interested in talking about MCE's model on the investor side? I think that's a very innovative model.
Yeah, thanks, Jim. So Dan, we typically blend deals or blend capital at two levels. So we have a blended capital approach at the overall MCE level where we can use guarantees to take increased risk, but we also blend at a deal level. And this is what lets us go into some of these venture debt situations that may look kind of a little riskier to sort of more traditional debt investors, bringing a range of different types of capital into a particular deal, whether it's DFI guarantees. In some cases, we're able to even put grant financing to work against a particular deal at sort of 0% cost of capital to help de-risk. And so there are ways that we try to sort of blend the capital we have available to us for each individual transaction to be able to do some of these deals where we're seeing a huge opportunity from our perspective to have impact and help the company grow. But our traditional sort of senior debt instrument funded the way we typically fund it isn't going to work.
So you're doing it at a fund/investor level versus forcing every borrower to kind of do the blending themselves, if you will.
Yeah, that's a good way to put it.
Rob, what thoughts on your side?
Jim, I'd love to give you a one-size-fits-all tool, but we very much, have a bottom-up approach. We have done, trading entities or LLCs at a holdco level, and then individual deal approvals below that. For example, with Carnival, we provide a revolving credit facility, and then we look at the drawdowns on that at a country-by-country level. So that's maybe a very sort of bespoke approach. We have also worked with two of our other portfolio companies, Leapalater and Workstyle, both in East Africa, to provide something that looks more like intra-equity round term loans with sort of very clear milestones. And we've done that at the local entity level. And then lastly, on the revenue-based lending side, I think that lends itself most to sort of low or high, let's call it high frequency drawdowns with high visibility on growth, almost in real time if possible. And in that sense, I find South Africa to be a very interesting market because all of a sudden there's a lot more sort of reach for SaaS-like products and services by large financial services companies. So the answer is it really depends on what the business needs. And I think it's really good to have an open mind when you assess the prospects of the business to try and deploy one of these tools rather than sort of try and make something fit all businesses.
Yeah, no, certainly. There certainly isn't one size fits all. And certainly there isn't going to be one instrument or one approach that meets this entire market. Let me just jump in with what we do, Dan, if it's helpful. I'm happy to talk offline in more detail, but essentially we finance the future digital revenue streams of digital assets or assets that can be digitally managed. So if you can imagine PayGo water systems, PayGo energy systems, etc. But what we then do is we consolidate, aggregate that demand across geographies and across sectors. So we create enough economies of scale to be able to offer a diversified set of assets, all digital and all backed by digital revenue streams, but offer that to investors in the US, in the US currently. So that's the approach that we've taken. And we think that can address a large number of asset heavy or companies that need CapEx financing to grow. Thanks for that common question, Dan. Moving on, Rose, would you like to jump in with a quick intro and a comment or a question?
Yes, thank you for calling me on. So I'm Rose, and I'm kind of obsessed with space. My profile pic is actually a Norman Rockwell painting in honor of Gus Grissom and John Young. But the question I have is actually related to it. So because of certain dynamics, the equator is one of the best places to launch a rocket from. So as compared to Cape Canaveral, from the equator, we can send 160 kilograms of payload, more payload for a vehicle like the Science. When you are spending around $10,000 per kilogram, that adds up quite fast, right? That's $1.6 million of like extra payload. So it makes, so if you look at the map, Somalia is at the edge of the eastern side of Africa, and if you can put alongside there a large physical asset place as well as manufacturing across Africa and ways to transport rockets, it would be a very, very interesting economic proposition that it's unlikely that most other countries can replicate, because it is about location, location, location. The other asset-based business, as far as I can see, that would be really interesting for a place like Africa is ground stations. We have to communicate with spacecraft as they go over different parts of the Earth. And so you need this continuous line of ground stations across the Earth that can do this relay race and hand over communications of the spacecraft as they move. Africa as a continent is so large that it can provide ground stations to cover really different kinds of orbits for different inclinations. An inclination is like an angle to it with the Earth's equator. It's the angle at the orbit is at. So Africa once again
very interesting.
Yeah, exactly.
Very interesting. Hopefully Elon Musk is listening and he's going to give you a call soon. But that's a very interesting idea. It's first time I heard that. No, thank you for that comment, Rose. Yeah, so Muhammad, if I'm pronouncing your name, Muhammadu, sorry. Over to you. Okay, moving on to the next one. Go ahead, please. Hi. Yes.
Yeah, thank you so much for giving me the chance to participate. I'm gonna let you just a little bit my background. My name is Mohamed. I'm originally from Senegal, and I grew up in France, Versailles. I do my school over there. Like 4 years now. And actually, I'm running like a business. I have one company in Dakar, West Africa. And I just created like another company, GAFA LLC in United States. And just like our services, like to give African people financial services. And we estimate a success, the West Africa diaspora community is almost like 40 million people strong. And the money they send it home make her difference, like to live of thousands of family. West Africa estimate have received remittance in 2019, accounting of 10% of the country. Actually, like we trying to build, we have our own platform because first of all, we already have like our own license with the central bank in West Africa. Because if you want to do financial services like money transfer and give people like don't have access like to have bank account, because like we know that it's different in the United States or in European, because like if you want to have a bank account, you can't find out like a lot of proximity bank like on your country or on your city on those kind of stuff. And most of people they have mobile phone. Actually, like our services is just like to give people access to have like bank account. Anybody have like mobile, you can have like bank account attached like with GAFA, and you can have access to sending money. You can have access to pay your bill payment. You can have access like to do all kind of services mobile banking. Actually, what we're looking for is like a partner who can help us like to build it together like the same project, because we already have like all those kind of stuff, like the platform technical is ready and we already have our license, and to give our community as well to have access to use our platform to send their money to help their family as well. Thank you so much.
Thank you for that, Mohammed.
Can I make a comment?
Yes, please. Go ahead, Ed.
Thank you very much. So my name is Ed Bisati. I'm from Nairobi, Kenya. Mohammed, I have someone who's doing something similar in Kenya.
Fuck up. Shut the fuck up, bitch ass nigga. Shut the fuck up, pussy ass nigga. I'll slap you, bitch.
What's going on?
Well, looks like we have a.
Shut the fuck
we
up.
Have...
I'll fucking piss in your wife's mouth.
Block. I'm blocking.
Okay.
I'm blocking. I'm blocking. I'm blocking.
Thank
Yeah,
you.
Thank
you very much.
I blocked him. Yeah, we have a.
Yeah.
We have
a
troll.
A
rogue guy, right?
Yeah.
It's okay. It's fine. I mean,
a clubhouse crasher.
What a sad,
so
sad life to lead.
Yes, indeed. Maybe they need more venture debt, and then that thing.
Then venture morals. Anyway,
go ahead.
Mohammed, I've listened to you, and I have someone who's doing something similar in East Africa. I'd love to connect you, the two of you, and sort of see how you can explore the greater African opportunity in that regard. So if you can allow me, then I'll definitely do that. So as an introduction, I'm Ed Misati. I'm in healthcare, and we're talking about venture debt. So the way we think about healthcare, we've studied healthcare for a while. My background is in corporate finance. I've done healthcare transactions, but what I've come to realize is that investors typically focus on the operation side of healthcare, but the challenge you face is that there's two things you leave outside the conversation, and one is real estate, because we are focused on secondary healthcare, which means if you're an inpatient and you have to stay in the hospital for a few days, then we have to provide you, a bed and a ward or a private room, etc. And then there's technology, because we've encountered founders who've been in operation for about 20 years, and they've just adopted ERP technology in the last 5 years. So for ourselves, we think of ourselves as, creating a true healthcare platform, in the sense that we've got the capability to focus on the upside, but we understand that you can optimize your upside all you want, but just like in the hospitality industry, if your real estate is for lack of a better word crap, then again you don't get to attract as many people as you'd want to your facilities. And then of course technology side, where if you're not able to process your patients in good time, then again, because you're doing things manually, then again you get to miss out on a bigger market share. And so we're generally focused on the three verticals within healthcare, which are the operations, the real estate, and the technology on the ERP side, just because that's essential to patient care. And that's what I do. I co-run a partnership called Rubik Health Africa, which is targeting investment and as well targeting assets in the African space to acquire middle market hospitals to consolidate them. I'll stop there for a moment to take any questions or comments.
Thanks for that. I should connect you with somebody else also named Ed, who is very interested in investing in healthcare and supporting healthcare related companies in Africa. So let me do that offline, and feel free to get in touch with me in case I forget. I definitely want to connect you with him as well. But any comments or reactions to Ed's?
Yeah, I'd just say, Ed, great that sort of there's the focus on the real assets that can unlock sort of healthcare solutions. We've definitely looked at a couple of businesses more in Southern and West Africa that try to build, platform plays with the view to managing real estate assets, but also having seamless integrations via an ERP, and really, really love that model. I think that, one of the key challenges we found is just how to unlock the virtuous circle of, who the customer is first. Is it, hospital managers, end patient customers, insurance? It all needs to be done. And I think long-term is a tremendously valuable space for capital to flow into.
Right, and I agree with you, Rob. So the customer is the patient, and if you think about it, if I own a hospital, I have to finance the real estate, and I have to finance the acquisition of a technology that could service patients. The way I do that is either I get credit or I price my products accordingly, and then the patients walk in. And so you have a combination of external financing and of course your revenue that's coming in and how you think about your revenue. And so in the grand scheme of things, how we've thought about it is, as you acquire the operating entities and scale those operating entities, you immediately create a scalable operation that can say, okay, now how do we think about real estate and say, can we use the real estate to acquire? Can we use the operations to acquire the real estate? Because remember, in every healthcare facility, the real assets are financed by the operations of the hospital or clinic. And then when it comes to the technology side, we discovered a sort of, and I say advanced deliberately because healthcare is technically a laggard in terms of technology. So we discovered an ERP solution that was pricing by the patient. And one of the flaws they have is that they don't price outpatient, differently from inpatient. And of course, those requirements are different. And so we approached them and said, you know what, we are acquiring hospitals. How about we partner and revenue share, in the sense that outpatient has a different pricing model from inpatient. We give you access to a platform that over time will grow significantly and provide you with revenue. But of course, we have to earn something ourselves. On the real estate side, the bigger question becomes, if my hospital is up to capacity and I want to increase capacity, who bears that burden? And is it the hospital or the real estate owner? And funny enough, every time this question is asked on the smaller facilities, the answer is let the hospital foot the bill and then you'll recover it from the rent. But that's my cash flow as the OpCo. So I have to think about, what do I have to forgo just to make sure I build an extra floor, or I sort of spruce up, the private rooms. And then I go back to the landlord and say, I spent $10,000, $20,000 or $500,000 just to get the rooms to attract the kind of clientele I want. And so the solution to that is obviously external investment. Are there other people out there who think about healthcare real estate in a different way? And so we researched and we found great models in the US and the UK, but the models we thought fit Africa so well are the Asian models: Singapore, Indonesia, Malaysia. They've got great models that fit, particularly because the structures they use are real estate, what we call real estate investment trusts. And those fit right into the healthcare model. So I'll stop there and then maybe encourage some questions.
Yeah, thanks a lot for that, Ed. We do have a comment or a question from the YouTube audience as well, from Daniel
Great.
Diaz. For what industries and for what level of maturity is venture debt relevant? Assuming that venture debt is not relevant to finance greenfield infrastructure project development, for example.
So I'd say venture debt is, depending on the amounts, it would suit healthcare in the instances where you want to finance the acquisition of a healthcare platform. So a healthcare facility to build a healthcare platform. I'd also think about venture debt in the instance where you want to finance the acquisition or the licensing, in our case, of technologies that you'll scale and get some recurring revenue from, just because you're on the upside, you're also scaling. And I just want to point out one thing. On the ERP side, the biggest weakness is the fact that if you're an ERP vendor to the hospital market, it's basically a democracy, meaning you've got another 10 to 15 to 20 people who are pitching the same business. If you're the person acquiring the hospitals, then you have a say in saying, I want software X to be running all my hospitals. And then that conversation changes when you approach the vendor and say, I'm giving you access to a platform and a market that you can capitalize on. Can we have the conversation on revenue share? I just wanted to make that comment.
Thanks, Ed. Thanks for the comments and your perspective. Mbwana as well, over to you. Would you like to provide a quick introduction and tell us a little bit about your comment or question?
Thank you. So Mbwana, managing partner and founder of the Savannah Fund. Done equity investments, early stage tech startups for the last 7-8 years, onto our second fund now. I have looked at venture debt, and I had a few comments around how I came across it and some questions for those who are doing it or planning to do it. I guess the first venture debt play I've come across is Silicon Valley Bank, really, given my time I spent in the Bay Area. And they also had given me some advice, because I asked them about this question about venture debt in Africa. And they said, yeah, we've tried it in India and LATAM, and I think they sold their venture debt portfolio in India. And they told me that typically in a new market, an emerging market or a new market, typically venture debt comes last after the VCs have started investing and the ecosystem matures. And of course, local players tend to be really good at that, and I think that's why they sold their portfolio there. Right. So I'm wondering what the panelists think about folks like Silicon Valley Bank or even local banks. So shouldn't like the major banks like EcoBank or Standard Bank or whoever be getting into this as a way to participate in the ecosystem, particularly those who have a FOMO in fintech or other areas. I mean, we saw some debt frenzy in East Africa with the lending, the micro lending, but it's not venture debt, obviously, but it's another type of lending. Some banks got into it, some burned, some have done very well. So that's one question I had. And then another question I had.
So question this is, where is Kenya's version of Silicon Valley Bank? Right.
Yeah, where's Kenya's version of Silicon Valley Bank, or will a foreign player from another emerging market or even Silicon Valley Bank itself enter the space, and when? And then the other one I had is quick one is currency risk for those who are doing about venture capital. Obviously, Africa's got a lot of volatile currencies, and I'm curious to hear from Rob and others how they manage the currency risk and hedging. Because, for example, South Africa last year obviously had a very tough time. Kenya is a little bit more stable. Other markets like Nigeria also volatile. So I'm curious to hear about that. So 2 questions. Thank you.
Hey, Mbona, great to see you here. It's been a while. Yeah, I think that the question I would ask is, where is Africa's lighter capital or WTI maybe before Silicon Valley Bank? Because I think those businesses might exist first, which sort of goes back to the notion of revenue-based lending and sort of off-balance sheet financing. And we've seen a couple of players emerge at the regional level to start filling those gaps. I think we're a long, long way away from the banks sort of creating assets in the venture space. If you think about the fact that sort of, especially in Nigeria, typically, banks would be paying 4% on deposits and then earning 20 to 24% in treasury bills, and are only sort of really now starting to do asset creation at large scale to, consumer lending. So I think it might play out a little bit differently. We've definitely sort of worked with a couple of funds that specialize just in this, that have the potential to be, a WTI or a lighter capital. And I think for Africa, again, sort of to the earlier point on data, it'll be solved. The analogy I'll use is like consumer lending in the US. I still can't get access to credit by using a utility bill, even though I've lived in the US for 7 years. I'm just not a Con Edison user. And so in the African context, alternative data sources will unlock non-equity financing before the data sources that banks use right now. Quickly on your question on sort of currency risk, you're absolutely right. Oftentimes the cost of hedging offsets the return of providing local currency. The encouraging thing is that, the DFIs are increasingly deploying local currency debt in our markets, definitely in East Africa. And what that does is it brings sort of the average cost of funding down for a business, because if you think of it as sort of tranched structures, we would typically be subordinated to that kind of capital. And so the average, cost of funding to the business is massively impacted by 4 to 8% local currency denominated funding. We've typically done, US dollar based lending in our portfolio so far.
Thanks for that, Rob. Thanks for the question, and thanks. Go ahead, please.
A quick follow-up. I think in our portfolio, we've seen DEG be quite active in deploying these sort of venture debt type structures. I think they provided capital to Moringa School, Sendi, which is obviously working capital heavy, and it's super cheap, and obviously undermines any bank lending that could come in there as well. So thanks.
Yeah.
Kwame, are you familiar?
Go ahead.
Go ahead, Rob. Kwame, are you familiar with? Go ahead. Sorry, Rob. Go ahead.
I was just going to sort of final point, Mbona, not only directly but also in sort of special vehicles. And one I would point to, especially regarding the earlier conversation on healthcare, is structures like Medical Credit Fund, which is ultimately FMO capital, but is managed on a deal-by-deal basis for entrepreneurs building in the healthcare space in Africa at really good sort of cost of funding now.
Rob, I just heard what you said, and so one of the things we've been exploring is, I'd say, receivables insurance, and we've seen bigger insurance companies like AIG sort of come up with products that are around receivables insurance, which is, in a sense, an evolution of credit based on what you have in your balance sheet, and we don't have those products in East Africa, and so we are thinking around challenging insurance companies to just figure out how to provide that kind of product to healthcare business, because there are many. Mwana, I last, I think, met you at Serena Hotel in Nairobi. That was a while back. We're discussing offshore investments. Sorry, I've got a young daughter who's expressing herself in this discussion.
She's trying to crash bomb.
She's trying to crash Clubhouse, venture debt Clubhouse. She has an opinion.
No, she wants some venture debt. She's saying
she wants she wants venture debt. But I had a call this afternoon, which was very interesting, where I've got a guy who's got a 1 million private debt fund, and he's not discriminating on the way of venture or private debt, and that would be interesting to just talk to whoever in this panel how that proceeds. The minimum exposure they have is about 200,000 USD in debt, and they like debt, so and that's very encouraging.
Okay, what was the name of that institution again? Sorry.
So so this is a private individual doing it out of his balance sheet with some friends.
I see. Gotcha.
Yeah.
Hey, Jim, it's Camilla. I just wanted to jump in quickly before I have to jump off. But one comment, just getting at both those questions, where is Kenya's version of Silicon Valley Bank and how to manage currency risk? I see a huge opportunity for guarantee facilities to get local commercial banks into earlier stage lending. It worked in microfinance. It's working in agriculture right now, where there are a number of new facilities and efforts like Aceli in Africa, trying to get more local commercial bank funding into the earlier stage market. And I think that's really the holy grail.
Great. That's a very insightful note. So how do we encourage more guarantee funds into instruments like this? Do we simply need to engage those who are providing the guarantees more? What's MCE doing to do that?
Well, one of the things that we are going to be doing is we're joining the Aceli network in Africa, which is designed to really get at the pretty massive supply-demand gap for financing for agricultural small and growing businesses. They have brought in a number of commercial banks to that program as well. So pairing up international lenders like MCE with some of the commercial banks, just either co-invest, go in together in some way or another to start getting the local commercial banks more comfortable with these types of loans. At the same time, I think it's actually a huge opportunity as well for some of the DFIs who have guarantee capital to put to work, to think more along the lines of facilities that are going to be unlocking local commercial bank financing for these companies. It's local currency, local and more sustainable.
Got it. No, thanks for that, Camilla. Very much appreciate it. And Guy, and thanks for joining. In case you need to jump off, feel free, but I really appreciate you joining. But we have one more person that I'd love to hear from. Gaetan, please introduce yourself and love to hear your comment or question.
Sure. Hi, everybody. So I work for a company that it's a SaaS company. We provide CRM to last mile distributors. Typical segment would be the off-grid solar space. And I'm really not an expert in all the financing and all that stuff, but we do find ourselves talking to a lot of small companies that are starting in the space of solar off-grid, following the footsteps of companies such as Bbox and all of those ones that today make the headlines. And our role is not to fund them, but we would like to be able to redirect them to the right funding groups or institutions. And where we sometimes hit a hurdle is, they're very sometimes too early stage, but they still need to make that first capital purchase to get all those solar kits in. It might be 25K, 50K, 300K, whatever they need to really get their business going in terms of products. They have the structure in place, the salespeople in place, the business in place, but they need to make that first capital intensive purchase. And we find that very often they're stuck in that step. So my question is, what would you recommend, redirect organizations you might know that could help them? And I might add, actually, sorry, that they don't have much to show in terms of sales because they're in the very early stages, and that's probably where the chicken and the egg effect comes.
Thanks for that, guys. Any takers on this comment or question? Rob, Kwame, Ed, Mohammed.
Sure, Jim. Quick response, and then I got to hop as well. I would say, Gaetan, the starting point here really is probably trying to build some kind of pipeline visibility, in the absence of actual offtake, something like a high visibility, HubSpot data set would probably help a lot, and sort of tracking and monitoring that. We all know closing that first customer is definitely the hardest thing to do. But if you can provide visibility sort of on pipeline and help drive those initial sales closes, that's where the virtuous circle starts. I'm happy to think about it more deeply with a little bit more info provided if you want to connect directly. And Jim, just wanted to thank you as well for hosting this really good session. Thank you very much.
No, thank you for being on the panel. And with that, I'd like to just pass it back to the panelists for last words. Would you like to start with that since...
sorry, Jim, I wanted to add to Gaetan's point.
Go ahead.
Hi, Gaetan. It'll be good to connect with you as we're looking to invest in these sort of off-grid solar projects. We actually co-invest alongside our partners, Pash Global, who are also almost like a sort of venture capital subsidiary of Trafigura. That's sort of this setup. But in terms of the ticket sizes you mentioned, that's something that is our cup of tea, especially if it's in Africa. So I'd be happy to connect with you on LinkedIn.
Okay.
And how do we get in touch with you, Anthony, if we need to?
Yeah, LinkedIn would be easiest. My Instagram's linked as well, but it's more of a personal one. So.
Okay, so for those of you listening on YouTube or LinkedIn, Anthony's LinkedIn ID is AOE29.
To make things easier, it's Anthony Efionai, EFIONAYI. And that's all I wanted to say. Thanks, guys. Bye.
Thank you, Anthony. And so going back to famous last words from Kwame, Ed, and anybody else who likes to jump in. Kwame?
Thanks so much for organizing this, Jim, and for everyone for sharing your thoughts. In terms of final words from me, I think my encouragement to the investors in the room are to explore more debt instruments and to get creative with them as a way to finance and partner with entrepreneurs in frontier markets. We have been able to grow over the past 3 years in particular, thanks to debt and raising a mix of debt. So that's debt from Kiva, debt from MCE. So Kiva being crowd-funded, zero interest debt, MCE being tri-party debt that's backed by a purchase order. We've also been fortunate enough to access debt from private individuals, sort of the 3 Fs, friends, family, and fools who believe in you. And they're my favorite 3 Fs. And they've partnered in financing us through their own personal savings and sort of investments, simple interest loans over a spread from 1 to 5 years. And then as well, others have mentioned the opportunity for revenue-based debt financing, as well as in AR and financing and invoice factoring. So I think there's just a large, opportunity here to play with different instruments that helps achieve attractive IRRs for investors, but really moves the needle tangibly for entrepreneurs in markets where venture equity isn't truly an option, and as well where there's so much more impact to be created if we had the right financing around us. Thank you very much for giving me the chance to share our story and journey.
Thank you, Kwame, for joining us. And any final words from Gaetan, Ed, Mohamedou, or anyone else?
No, this was great, guys. Thanks a lot.
Well, thank you, Gaetan, for joining us. Well, with that, thank you everybody in the audience as well for joining us. And just as a reminder, you can find out more and follow us at Untapped Global on Twitter and LinkedIn. And you can also join the community on WhatsApp by going to untapped-global.com and clicking on Engage. Thank you, everybody, and look forward to joining or seeing you and hearing you next week as well for our next Clubhouse Nest session. At the same time, 9 a.m. Pacific and 4 p.m. GMT. Thanks, everyone. Have a good week.
Thanks for joining, guys.